Ever wondered how to predict a stock market crash? It's a question that has intrigued investors, analysts, and economists for decades. While no one can predict the future with absolute certainty, there are several key indicators that can help you spot the warning signs before a crash occurs. Today, I'll share some key signs to watch for. By understanding these indicators, you can make more informed decisions and potentially protect your investments from significant losses. First, let's talk about market sentiment. Market sentiment refers to the overall attitude of investors toward a particular market or asset. It can be measured through various indicators such as surveys, trading volumes, and price movements. When optimism is at an all-time high, it's a red flag. Excessive optimism can lead to overvaluation, where stock prices are much higher than their intrinsic value. This often precedes a market correction or crash. Look out for excessive euphoria in the media and among investors. When everyone is talking about how great the market is and how much money they're making, it might be time to take a step back and reassess. When everyone is buying, who's left to buy more? This is a classic sign of a market top. If there's no one left to drive prices higher, the market can quickly turn downward. Next, keep an eye on economic indicators. These are statistics that provide insight into the overall health of the economy. Key indicators include GDP growth, unemployment rates, and consumer spending. Rising interest rates often signal trouble. When interest rates go up, borrowing costs increase, which can slow down consumer spending and business investment. This can lead to a slowdown in economic growth. Central banks raise rates to curb inflation, but it can also slow down economic growth. It's a delicate balance. And sometimes the measures taken to control inflation can inadvertently trigger a recession. Watch out for yield curve inversions too. This occurs when short-term interest rates are higher than long-term rates. They've preceded many past recessions. An inverted yield curve suggests that investors expect slower economic growth in the future, which can be a precursor to a downturn. Corporate earnings offer another clue. Earnings reports provide insight into a company's financial health and future prospects. If companies report declining profits despite high stock prices, it could mean trouble ahead. This disconnect between stock prices and earnings can indicate that the market is overvalued. It could mean trouble ahead. Pay close attention to earnings reports and guidance from company executives. If they are lowering their forecast, it might be a sign that the market is headed for a downturn. Pay attention to earnings reports and guidance. These reports can provide valuable insights into the health of individual companies and the broader market. Valuation metrics are crucial too. One of the most commonly used metrics is the price-to-earnings P ratio, which compares a company's stock price to its earnings per share. High price-to-earnings ratios suggest that stocks are overvalued. When valuations are stretched, there's less room for error. This means that any negative news or economic data can have a more significant impact on stock prices. There's less room for error. Overvalued stocks are more susceptible to sharp declines, so it's essential to be cautious when valuations are high. Liquidity is often overlooked but vital. Liquidity refers to how easily assets can be bought or sold in the market without affecting their price. When liquidity dries up, it can lead to panic selling. In a liquid market, there are plenty of buyers and sellers, which helps destabilize prices. But when liquidity is low, even small trades can cause significant price swings. Monitor the money supply and credit conditions closely. Changes in the money supply can impact interest rates, inflation, and overall economic activity. Geopolitical events can also be a catalyst. Events such as trade wars, political instability, or natural disasters can have a significant impact on the stock market. Trade wars, political instability, or natural disasters can trigger a crash. These events can create uncertainty and fear, leading to a sell-off in the market. Always stay informed about global events. Keeping up with the news can help you anticipate potential market-moving events and adjust your investment strategy accordingly. Lastly, historical patterns can provide context. While history doesn't always repeat itself, it often rhymes. By studying past market cycles, you can gain insights into how the market might behave in the future. Look at past market cycles. They often rhyme if not repeat. Understanding these patterns can help you identify potential turning points in the market. They often rhyme if not repeat. Recognizing these patterns can give you an edge in navigating the markets. Recognizing these patterns can give you an edge. By being aware of the signs and staying informed, you can make more informed investment decisions. Understanding these signs can help you better navigate the markets. It's not about predicting the future with certainty, but about being prepared for different scenarios. Stay informed, stay cautious, and always be prepared. Thanks for watching. Remember, the key to successful investing is not to avoid risk entirely, but to manage it effectively. If you have watched until the end of this video and think you've learned anything new or anything of value, please don't forget to press the like button and subscribe to the channel to stay up to date with all the videos. Don't forget to press the bell icon as well. Stay safe, stay healthy. Thank you.